of Income Tax, Part 15. We are going to be talking about Chapter 13 of the textbook, dealing with issues relating to students. This is the British Columbia version of the content. Where we discuss provincial topics, we'll be doing so from a British Columbia angle. It's important to stress that particularly with students, the rules around tuition transfer to spouses or other supporting individuals and the rules for tuition carry forward vary quite widely by province. So you want to make sure that you are familiar with the rules for your particular jurisdiction. All right. But welcome back, everyone, for my class here. It's been about 48 hours since our last class. Hopefully you at home haven't had a huge lag between this and your last class. Just a reminder to everyone, if you do happen to lose sound or lose connection and need to sign back in, this checklist here can be helpful for getting sound again. And do be aware, sometimes WebEx, if you click it the wrong way, will spawn a second window underneath the first. So just be aware that that's a possibility. And of course, if my sound cuts out in the middle and it appears to be an accident, and you all have that issue, do put a note in the chat. Doreen will try to get my attention because sometimes it's possible for me to nudge the wrong key or accidentally mute myself. And sometimes WebEx can sometimes mute the presenter for no obvious reason, and it won't necessarily be obvious to me that no sound is going through right away. So do let me know. All right. As always, I want to stress questions and interaction are key to this course. So if there's anything that's unclear, anything you have questions or concern about, please do ask. This is especially important for the recorded session, where the folks at home do not have the chance to ask questions. So if anything seems to be unclear to you, it's probably unclear to somebody else. Don't be shy about asking. All right, there's no such thing as a bad question. There sometimes is such a thing as a question which is beyond the scope of the course or that we will have to take offline, but there's certainly no harm in asking if anything's unclear. So in our last class, we talked about what are called family situations. Basically, situations in which there's surrounding a change of marital status in the year and what can happen in the year of marriage or becoming common law partners, how that has an effect on things, and also after a divorce or separation, what is the effect on various credits and things that can be claimed. So we talked about support payments, and again, these are payments which are required by law under the terms of a court order or written agreement. Adoption expenses, these are the expenses that you can claim when legally adopting a child, and those expenses can be expenses for more than 1 year. However, they are all only claimed in the year that the adoption is finalized, and then there is a limit which is adjusted for inflation, but there is a limit to what can be claimed, which varies by year. Then we look at the various rules and regulations around childcare expenses, which there's a surprising amount of rules and regulations about, but it basically boils down to they can only be claimed when they are incurred to allow the taxpayer in a couple with lower income to either work or go to school. For single taxpayers, of course, that's not a concern, but they still need to be encouraged to work or go to school. And then we work through the various tax consequences and effects of these various marital status changes. Now, if any of you guys have any questions left over from last time, feel free to throw them at me now. But last time, we didn't get a chance to go through chapter review problem 12-2, so we're going to do that first. And you might have questions which arise around that. For anyone who's downloaded this who already covered 12-2, please feel free to skip ahead in the recording. All right, so 12-2. Just to refresh everyone's memory, this was an example of what happens after a separation. So Alan Malone and Lynn Williams are the two taxpayers here, and they were married to each other for many years until April 2024 when they legally separated. So after the separation, Alan began living in his own apartment on Lansing Avenue and would like to receive online mail from the CRA so that the physical mail doesn't go to the old address. This is actually a concern that's, it's not just silly to bring it up. This is often a concern. We often do taxes for people in various points and stages in life, and sometimes we do taxes for people immediately post-breakup who have real and legitimate concerns about things like that, about which address is on file with the CRA and things like that. So it's contingent upon us as professionals to try to make things as smooth and straightforward for everyone as possible, just to make an already stressful situation smoother. Alan and Lynn are the parents of two children, Amy, born 2008, and Earl, born 2011. Amy has some income from odd jobs, but Earl has no income. Neither child is infirm. Both children resided with Lynn throughout the year, except for the 2 months they spent with Alan during the summer. In May, Alan began making monthly support payments of $750 to Lynn. That is $550 for child support, $200 for spousal support. They have a written agreement dated July 2024, acknowledging all earlier payments as having been made in accordance with the agreement. This agreement also states Lynn has sole custody of the children, but Alan and Lynn have agreed for their agreement that Alan will not claim any child on his tax return as an eligible dependent or receive the CCB. Alan worked all year as a welder for Young Metal. Lynn works part-time as a commercial artist for Goodman Ad Agency. In addition to this income, Lynn received about $97.78 in Canada child benefits for the year. To allow Lynn to work, her mother agreed to take care of the children at no charge. However, while the children were with Alan during the summer, he paid Nina Garrett $2,000. That's $1,000 for each child to care for the children while he was at work. Alan is eligible to claim the child care expenses, and this is noted in their agreement. All right, so we've taken great pains to really make clear the legalities around the situation. In terms of T-slips, it's relatively straightforward. There's a T4 for Young Metal for Alan, and then there's a T4 for Goodman Ad Agency for Lynn. And then we have some questions, and then we're going to complete the form T778. So let's begin with the questions. Okay. So, all right, everyone. Per the separation agreement, Alan is required to make support payments. So, as a result, so just as a matter of fact, is Alan allowed to claim personal amounts for Lynn and the children? Note that it's the year of separation. Is he allowed to do so? Why or why not? All right, it's in the agreement, yes. Let me just expand the old chat window here so I can have a look what everyone's saying. So Gurjinder says, generally no, but if you were separated for only part of the year, you can choose whichever is beneficial. This is correct. In the year of separation, right, we do have the choice to claim support payments or the personal amounts, and that option does exist because of the because it is the year of separation. So we begin from that. It is a possibility, right? Just in general terms, in tax terms. he is allowed to as far as taxes are concerned. But the agreement does limit it, as we will see. Okay, so question 2. The separation agreement between Alan and Lynn states $550 is for child support, $200 is for spousal support, and his total payments for the year were $6,000. That is to say, he paid the entire $750 per month from May through December, so he's not behind on his payments. So then, should Alan claim a personal amount for Lynn? Sorry, repeat question 1, Karina? Yes, so for question 1 is Alan allowed to claim personal amounts for Lynn and the children even though he is making support payments? And the answer is yes, because it is the year of separation. If the agreement did not specify otherwise, he would be allowed to do so. For example, nothing is said in the agreement about a spousal amount. So, question 2, then, should he claim a personal amount for Lynn, is a valid question. So what do you think? Should he claim the personal amount for Lynn? I have yes and I have no. Good, Diane. Yes, he is allowed to, but that amount would be 0. So her income is too high, so claiming the spousal amount, although he's allowed to, would be 0, no benefit there. Oh, and one thing to clarify with question 1, just to be clear, for the children, he could, if the agreement didn't specify otherwise, he could claim the amount for an eligible dependent for the children because they were living with him at some point in the year. He would be able to claim an amount for eligible dependent on behalf of one of them instead, but the agreement prevents it from claiming him. Right? So he's allowed to, but the agreement prevents him from claiming amount for eligible dependent for the children. And for Lynn, remember her, Mohammed, remember her personal amount, right? So it would be the spousal amount, but it is reduced by Lynn's income. So for Lynn, her income is $24,000. That is higher than the basic personal amount of $15,705. So he cannot claim a personal amount for Lynn because the amount would be 0. Okay. Let's get back here. Now, Lynn is receiving support payments for part of the year. How much should she report? How much should she report on line 12799 and how much on 12800? And be sure to specify which. Good. So remember, so 12799, we report all the support payments, child support and spousal support for the year, all the support payments received. For 12800 is only the spousal support payments for the year, if any. And remember, if someone is behind on their payments, they don't pay the entire amount for the year, then all of the support payments are considered to be child support until the entire amount of child support for the year is paid, and then only the remainder is considered to be spousal support. In this case, he is not behind, so for line 12799, it will be 6,000, and for 12800, it will be 1,600. Now, related to that, Does the amount Lynn reports on line 12800 depend on what Alan reports on line 22000? That's right. So remember, for the support payments made, the total support payments made are on line 21900. So her total support payments paid should match what is on his total support payments made. So her 12799 should match his 21900. But the deduction for Alan is optional. So it's not necessary that it matches. It doesn't depend on it. So even if he doesn't claim a deduction for some reason, Lynn must still show the income on her return. I suspect part of the reason that those lines are not checked against each other probably also has to do with the fact that in some cases you might have people who are receiving or paying support from multiple former partners, or at least more than one. So I suspect in some cases it's not as simple for the CRA as to simply match A to B. But that said, the total support on 12799 and 21999 most likely should correspond. So what the answer is no. It doesn't depend on what Alan does. What Lynn reports is independent of what Alan reports. Because for Alan it is optional. For Lynn it's not. It is income. Income must be reported. Deductions remain optional. Okay, now for Alan, speaking of that, can he deduct the support payments he made, and what would be the amount? So if Alan makes a deduction on line 22000, what is the maximum deduction he can claim? Good, that's right. So that is spousal support of $200 per month for 8 months is $1,600. Very good. And again, that's because he is all caught up on payments. He's not in arrears. And notice that the payments made prior to the agreement being signed are included because that is explicitly stated in the agreement. Okay, so what effect then does the separation have on the Canada Child Benefit and the GST credit? Let's start with the Canada Child Benefit. Just in general, what would effect would the separation have? That's right. So the family net income has changed. So in this case, Lynn has custody of the children, so it's going to be recalculated based on Lynn's income only. Alan is not claiming it, again, as per the agreement, so there's no ambiguity here. They should both notify the CRA after 90 days has passed so that the CRA can do that recalculation. What about the GST credit? So again, this is based on the family situation. So in this case, because they are no longer a couple, both of them, both Alan and Lynn, will have their GST eligibility recalculated based on their individual income. All right. Now let's look at the child care expenses form, T778. In this case, it's relatively straightforward, but I think it's good to walk through the form. So we have Amy and Earl here. And notice we have their names and their birth dates listed at the top of the form. We always list all children involved regardless of whether childcare expenses were incurred for them, because this increases the overall limit. So Amy and Earl are listed here, $1,000 childcare expenses for each of them, and then we list the name of the individual and the social insurance number. there. So it's $2,000 total expenses. There's no overnight camps or anything like that, so it's nice and straightforward. So for the limit is calculated in Part B. So we have 2 children, the maximum per year per child for an eligible child who is not impaired and is born from between 2008 to 2017. It is $5,000 per year. So 2 times 5,000 is 10,000. That is the first limit. The second limit is the actual childcare expenses paid for the year, 2,000. And the third limit is 2/3 of Alan's earned income. 53,000 times 2/3 is 35,333.33. So whichever is the least of these 3 amounts is what is the limit. In this case, it's 2,000, the actual expenses paid, and this is the allowable deduction that Alan can make on line 21400. All right. Now, because Alan is single at the time he's claiming the child expenses for, there's no need to complete Part C, and because Alan is not going to school, there's no need for Alan to complete Part D. Okay. So, does the tax return make sense? Well, when we look at the tax return for Alan, which I believe should be right down here, we look at the result for Alan, dismiss that. Maybe I'll open this up in Adobe. That might be easier. Downloads, there we go. I can make it bigger, yes. There we go. And we will just go down here. So again, this is a fairly straightforward return. Alan just has one source of income, the $53,000. From this, we deduct the registered pension plan deduction from the T4. The child care expenses of $2,000 are deducted here, line 21400. The support payments are also deducted here, right? So those are deducted here, the $1,600, and then the CPP in hand, that is $48,125. And the tax on that is $72,1875. There's no unusual credits being claimed, just the regular CPP contributions, EI, and the Canada Employment amount. So his total tax credits are $20,468.05. 15% of that is $3,070.21. So we take the tax on the taxable income, deduct the tax credit, and that leaves him with federal tax of $41,48.54, provincial tax of $16,35.04. The total payable is $57,83.58, and the total income tax deducted is $76.07, giving a refund of $18,23.42. And Karina asks, can everybody claim the Canada Employment amount? Everyone who has employment income, and I believe is a Canadian resident, can claim it, Karina, yes. A good way to think of it is it cancels out the first $1,433 of your employment income, but only employment income. So it doesn't cancel out, say, business income or investment income or pension income or things like that. But otherwise, generally speaking, if you're a Canadian resident and working in Canada, you can claim the Canada Employment amount. All right, so it's a total refund of $1,823.42. Does that make sense? I think that would make sense in this case. It's a reasonable refund, especially considering that he's able to claim the support payments as a deduction, and he can claim the child care expenses as a deduction. For Alan, going forward, what tax tips might we have? If I were talking to Alan, I would want to get a sense of whether he anticipates his income being higher in future years. If he's going to be in that second tax bracket, he might want to consider contributing to RRSPs. Also, I would want to make sure he understood the importance of making sure his support payments are paid on time so that he can deduct the full amount every year. But apart from that, he has a fairly straightforward return. So there's not a whole lot to suggest here, but I would want to talk to Alan and see what his future plans are, if there's anything interesting coming up on the horizon, if he's planning to buy any houses, make any investments, that sort of thing. Yes, Gurjinder, what would you like to see? Just the previous slide with the T778? Okay. So the T778 again, right? So the key part of it, no. Oh, his tax return. Sure. Right. So again, the tax return. So the final result there is a refund of $1823.42. What was there a specific thing you'd like to focus in on, Gurjinder? So the 1541 is smaller than the total credits? Oh, line 154. Yes, so this is the balance owing, right? This is the total payable, and this is less than the income tax he's had deducted. So that means he's getting a refund. Right? So, and that's really what it comes down to. Line 154 will be the amount that is payable. And if it's a non-zero amount, then we compare that to the refundable credits in this section and the income tax deducted. And if you've had more income tax deducted than you owe, then you get a refund. And if you've had less income tax deducted than you owe the government some tax. So it's all about trying to get someone as large a refund as possible, or at very least, minimize the amount owing at the end of the year. Okay. Thanks for checking in. All right, let's get into today's stuff. And a reminder at the beginning of class, in case anyone has to peace out early, chapter review problem 13-1 is assignment number 2. It is worth 20% of the final mark. I mentioned it to everybody last class. You could start to have a look at it. It's going to be reviewed at the end of our next class. Just a reminder to everyone, there will all sessions of this course are going to skip a day to allow you guys at home time to work on the assignment. So for my class here, we are not going to have class on Monday. Our next class is going to be a week from now on Wednesday. Also, in my class, I have mailed out the schedule to everyone more than once, so everyone has a copy of the schedule and then they can check the due date on the schedule. Believe it or not, I sometimes, last year I did get some emails from students who said that we never talked about due date for the assignment or anything like that, which kind of made me scratch my head. But then upon asking some questions, I discovered that student didn't actually listen to the entire lecture or read the schedule, and so I'm not sure what he expected me to do about that. All right, well, let's go on to our new material for today. So today we're going to be talking about things of interest to students. So we are going to be talking about types of income that are specific to students. We're going to talk about a type of registered plan, which is specific to students. That is a registered education savings plan. And then we're going to talk about some credits which are specific to students. That is student loan interest, which is relatively straightforward, although there are some considerations about it. And then the tuition tax credit, which is much less straightforward, but we will be going into that in detail. One of the things which makes tuition tax credits less straightforward is that they, together with a related credit called education and textbook amounts, which is not based on the tuition, but rather the number of months a student spends in school. Those tuition, education, and textbook credits are calculated on a Schedule 11, and then they can be transferred either to a supporting spouse or common law partner, or to another supporting individual, usually a parent or grandparent, who is presumably paying the tuition. We're also going to talk, and there are rules around all of that need some discussion. We're also going to talk about students and moving expenses, and as you will see, while students can sometimes claim moving expenses, the circumstances for that are a little bit limited. And we're also going to talk about what's called adult basic education assistance, which is a type of employment insurance payment for adults who are getting basic education rather than post-secondary education. So to break it down in terms of objectives, and remember, our learning objectives, these are listed at the beginning of every chapter. So if you come in late or you're studying for the exam, you can have a look at this to get a sense of what we want you to focus on. So by the end of chapter 13, you'll be able to define the different reporting rules for scholarships, fellowships, bursaries, and other similar prizes. You'll be able to explain the registered education savings plans in general and how we treat income that comes out of our ESPs. You'll be able to discuss and remember the rules for claiming student loan interest and how to calculate tuition fees and related credits for a student on Schedule 11, and then transfer the required amount to the tax return. As well, you'll understand how to determine unused tuition amounts and the options that are available in these cases, either to transfer them or to carry them forward. And lastly, how to claim adult basic education assistance and moving expenses that are related to students, as well as a refundable credit called the Canada Training Credit. So lots of good crunchy stuff in tonight's chapter. And then chapter view problem 13-1 is going to involve student topics. So, which is why you shouldn't attempt 13-1 until you've gone through this session and we've discussed the chapter with you. But first, for this session, we are also going to go over self-test number 5. All right, as always with the self-tests, this is a chance for you to gauge how well you're understanding the material and give me a chance to see if there's some points that I need to clarify for everyone. So if you who have downloaded this online have not done the self-test yet, please take a few minutes and do so. Just pause the recording. We'll wait for you, and then you can listen along as we go through. All right, but first, question number 1. So Linda is 71 years old and widowed. Her only sources of income are CPP and old age security. Can she claim the pension income amount on her tax return? Yes or no? All right, I have the question here. I'm going to set it for 1 minute. Students, let me know how well you remember. About 10 seconds left. Oh, okay. All right, that's about evenly split. WebEx is just going to tabulate the results, and then I will push those out to you. So since it's evenly split, I can see there's still some confusion about this. So just first of all, remember, as a general rule, if there's any type of income and you're not sure how to treat it on the tax return, remember you can consult the chart in our facts and figures guide, which will show you how to treat that income, that type of retirement income on the tax return. CPP and OAS, however, are distinct because they are not eligible for the pension income amount and not eligible for pension income splitting. Remember that CPP, for example, there is a type of CPP splitting which can take place, so it falls under that separate, there is that separate allowance made for CPP. But otherwise, CPP and OAS, they are not eligible for the pension income amount, and they're not eligible for pension income splitting. So remember, for the pension income amount, generally, and for pension income splitting, whatever the retirement type income is, it should be periodic, that is paid out on a regular basis and of a fixed amount. So lump sums and retiring allowances don't qualify. It should be from a source other than the Canadian government, so not Canadian Social Security type income like CPP and OAS. And it shouldn't be exempt from tax in Canada. So the exempt portion of foreign pensions also cannot receive this treatment. So CPP and OAS are not eligible for the pension income amount. All right, question number 2. All right, got it here. And I'm going to set the timer on this one. Read it. Okay, so Leonard is 67 years old and he received $10,000 in RPP annuity payments reported in Box 16 of a T4A and $5,000 in RCA income reported in Box 17 of a T4A RCA. Leonard's spouse is 64 years old and does not receive any pensions. So, if they elect to split pension income, what is the maximum amount Leonard could claim on line 11600? All right, now for this question, you might need to use the chart to answer it. So if you haven't already done the self-test, you're probably not going to have time to check this. You're only going to have a minute, but you can make an educated guess, I think. All right, so let's see what you think. You have 1 minute. Okay, and 2 seconds left. All right. I see. I need to make a note. Here. So here, the correct answer is D. So when we consult the chart, we would see that both the RPP annuity payments and the $5,000 in RCA income are eligible for pension income splitting. The subtlety here is that RCA income is not eligible for the pension income amount, but it is eligible for pension income splitting if it is reported in Box 17. All right, so 50% then of 15,000 is 7,500. All right, good stuff. Let's try question 3. Oops. Liu and Li separated on June 15th, 2024, and as part of their written separation agreement, Liu was to pay Li $200 a month in child support and $100 a month in spousal support monthly, beginning August 1st, 2024. Liu paid the first 4 payments in full and on time, but was unable to pay the December payment. So, how much can Liu claim on line 22000 of their 2024 tax return? All right. So, with chapter review problem 12-2 fresh in your mind, hopefully this one's not too tricky. Right, got question 3 set up here. We will set the timer for 1 minute. Please tell me what you think. All right. There we go. And again, a mix of answers, but the most popular answer was the correct one, which is good, but let me walk through this for you. So, move our chat window up here. And Karina, I do see your question. I will answer that in a moment. Okay, so in this case, remember that if someone does not pay the entire amount of support payments for the year, we have to consider that what they did pay during the year went to child support first. Okay, so what was actually paid during the year? So paid 4 months. So 4 months at $300 a month. So what was actually paid during the year is $1,200. And the required, oh, that's a typo, the required child support for the year is 5 months at $200 a month is 1,000. Exactly, Beanish. It's 1,000. So the first $1,000 of support paid in the year is considered to be child support. Only the remaining amount is spousal support. So in this case, it's a simple matter of 1,200 minus 1,000 equals 200 spousal support. Exactly, Venus. Exactly. Whoops. Well, I accidentally sent that to Doreen privately. Oh, that's okay. So I'll just put it back in the channel for you all. Doreen's probably wondering why I thought she needed a reminder. Okay, so again, so 4 months at $300 a month is $1,200. Required child support, 5 times $200 a month is $1,000. So therefore, 1,200 minus 1,000 equals $200 in spousal support. The answer is B. Right. Justin and Haley separated in July. Justin was not working when they were together and didn't earn any income prior to separation. And by a written agreement, Haley paid monthly spousal support to Justin for a total of $6,000 last year. So this is a yes or no question. Is Haley allowed to claim both the spousal amount and a deduction for spousal support payments paid? Well, I think this should be fresh in your minds. So I anticipate you guys will do pretty well with this one. So let me just pull up question 4 here and give you guys a chance to tell me yes or no. Is Haley allowed to claim both? Okay. All right. So another even split here. Okay. So remember, in the year of separation, it's an exception to the general rule. Generally speaking, you cannot claim any personal amount for someone that you are paying support payments for. In the year of separation, however, the rule is different. This does not, however, mean that you can claim both the spousal amount and a deduction for spousal support payments. You have to choose which will be more beneficial. You can either claim the person as a spouse or as someone you're making support payments to, but you cannot claim both. And again, this is entirely up to the taxpayer which to claim. Claim whichever is going to be more advantageous. And again, this is only in the year of separation. In subsequent years, except a year of reconciliation, the spousal amount cannot be claimed because you are no longer spouses. But in the year of separation, you are allowed to choose which one is going to be more advantageous. All right, and our last self-test poll question is number 5. So Tim and Jill are married and have 3 children, Brad, Randy, and Mark. And during the year, they paid a total of $10,000 to Borland Daycare in respect of Randy and Mark. Tim's net income was $40,000, all from employment. Jill's net income was $21,000, all from employment. Neither Tim nor Jill were in school nor infirm. All right. The question is then, who is eligible to claim the childcare expenses? Tim, Jill, both, or neither? All right, again, you've got 1 minute. Tell me what you think. Good. All right. WebEx is just tabulating your results. So, with childcare expenses, then, the key thing to remember is it's always a question of who has the higher net income and who has the lower net income. Bearing in mind that in some cases the income may be very similar. The person with the lower net income by default is the person who must claim the child care expenses. So in this case, the correct answer is Jill. Now, if there is an extenuating circumstance, if Jill is in school, if Jill is infirm, if Jill is in hospital, if Jill is, in other words, unable to care for the children due to one of the specified reasons on the T778, then Tim will be able to claim a portion of the expenses. All right, good stuff, everybody. All right, let's put our polls away for the moment. Now, there was a question about RCA. Someone was asking about that. Just to go back a few slides. So an RCA, remember, an RCA, that stands for Retirement Compensation Agreement, right? And you can think of that as someone who's receiving a retirement compensation package that is not through a regular company pension plan. So this is the sort of thing that is often given to executives as a retirement package, your classic golden parachute, things like that. So as such, depending on the details of the plan, there may be some interesting considerations around RCAs. At this level, the only thing we really want you to be concerned about is the fact that if they have income in box 17, it is eligible for the pension income splitting treatment. But it is otherwise not a conventional pension and thus not eligible for the pension income amount. All right, so let's move on to the topic of students. And as usual, let's begin with types of income that are specific to students. For students, the type that is really specific to students is scholarship income. This can also be described. A scholarship is an amount of money that typically a school or a third-party organization pays to a student to help them defray the cost of their post-secondary education. Similar vehicles are fellowships, typically administered by universities and aimed more at the professor level. Bursaries, which are aimed at students who are of limited financial means, so they are more aimed at students of lower income rather than students of high academic achievement. Students with high academic achievements can also receive what are achievement prizes. General scholarships can be given for a variety of reasons, including high academic achievement, but they can also be for students who are entering specific fields, students who are from specific places, and so on. All of this income is generally speaking, entered on a T4A slip in box 105. And it's been box 105 for many years now. If you go back far enough, it was reported slightly differently on the T4A, but at least for the last 10 years, it's been on box 105 on a T4A slip. If there is a taxable portion of the scholarship, that is reported on line 13010. So similar to other income. Now, when is a scholarship or similar grant of money treated as taxable? Well, first of all, elementary or secondary school scholarships are always non-taxable. Full stop. 100%. If it qualify for post-secondary education, it's a little more complex. So if the student is enrolled full-time in a qualifying post-secondary educational program, these are 100% non-taxable as well. However, their tuition tax form, the T2202, must show a minimum of 1 month of full-time study. For a part-time student, PS here is post-secondary. For a part-time student, students can reduce the amount of income declared by $500 as the basic exemption, plus their tuition fees, plus the cost of any program-related materials, books, photocopies, things like that. And there is an exception for disabled students as well, which we will note in a moment. Now, if someone is not a qualifying student, that is, they have a tuition form, but it shows 0 months of full-time or part-time study, or there is no tuition form at all, no T2202, then only the $500 of scholarships are exempt, are non-taxable. The same treatment is given to provincial training allowances. So let's just say that you are not a student and by error a scholarship is paid to you, then the first $500 of it would be exempt. Now, students who are enrolled in a part-time program, just to note the exception, they can claim the exemption that applies to full-time students if they are eligible for the disability tax credit for the year, or they have an impairment in physical, mental functions, and a medical practitioner has certified in a letter that the impairment would not reasonably allow the student to be enrolled full-time. So not all impairments necessarily would qualify. That information is then entered on page 2 of the Schedule 11, which we'll talk about on an upcoming slide. Okay, so these then are the major points. So scholarships are going to be exempt from tax and therefore not entered on the return at all for elementary students, secondary school students, and full-time students. It's only part-time students which have to do the calculation. And remember, if a student is disabled or infirm, they are treated as full-time students for this purpose. And if someone is not a student at all, then a minimum of the 500 is still exempt. Anyway. All right. Now, another type of income that a student might receive is payments from a registered education savings plan. This type of registered savings plan is a contract between an individual, known as the subscriber, and an organization, known as the promoter. The subscriber will then name a beneficiary, the future student. So if I go to RBC, Royal Bank of Canada, to set up an RESP for my son, I am the subscriber, RBC is the promoter, and my son would be the beneficiary. The subscriber agrees to make contributions, and the promoter agrees to make educational assistance payments. All right, so these terms are important for the discussion that follows. So subscriber, promoter, beneficiary, illustrated like this. The subscriber puts money into the bank or other institution, the promoter, and then the promoter makes payments to the beneficiary when they are in school. So RESP plans then are set up by the subscriber to save money for a beneficiary's post-secondary education. Now, unlike our RSPs, these contributions are not tax deductible for the subscriber. So the money that you contribute to the plan is post-tax income. It's not going to be subject to tax. The income that is earned in the plan is not taxed right away. So this is why this is a tax-sheltered vehicle. The income that's earned in the plan is not taxed. As well, if you put money into the plan, the federal government and some provincial governments will provide matching grants and bonds. These will vary by jurisdiction. In British Columbia, for example, there's a education savings bond which is available to all students, all children who are British Columbia residents, but you must apply between the ages of 6 and 9. For some reason, they're quite stringent about that age requirement, so you cannot apply too early and you cannot apply too late. As well, the government will match a percentage of your contributions as well. Your total contributions into a plan cannot exceed $50,000, and contributions are not allowed after the 31st anniversary of opening the plan. And the plan must be completed by the end of the year of the 35th anniversary. That 4-year period, of course, is the standard length of time to complete a post-secondary degree. All right. The matching bonds and grants for many people is what make RESPs the attractive investment they are. Essentially, you're getting an immediate 20% boost or higher by putting money into the plan. So for many people, that's really where the hook is. The investment income earned in the plan is going to be then sheltered from tax, so it can grow undisturbed in the plan until money is finally withdrawn from the plan. When the student eventually enrolls in a qualifying program, they will receive payments consisting of a refund of the original contributions, which again, this is post-tax money. The money you put into it, you've already paid tax on it. So when you get this money back, this is non-taxable. But the income earned by the funds within the plan, so your grants from the government, your bonds from the government, any interest that's earned, dividends that's earned, this is taxable. So this taxable portion then, called an education assistance payment or EAP, this is what is reported in box 42 of a T4A slip, and that is included in the student's income on line 13000. But again, it's only the income that's been earned, only the taxable portion of the payments is reported here. So in other words, any money which did not originally come from the subscriber is what shows up in box 42. Now I see a question. Valerie, the specific rules for BC I don't have handy. We can get into that in chapter 14 when we've got some time to look at BC issues specifically. I think in some circumstances, a grandparent or outside person can set one up, but I would need to check that. Generally speaking, though, it's the parents. The name of the bonds, the various bonds are listed in the textbook. We don't want to get too much into the detail here. Some of them are based on income, some are not. And the British Columbia one as well. It's specific to British Columbia. We will get there, Mohammed, for fees paid to a school can be claimed. We will get there. We're not there yet. We're still talking about income received by the student. All right. The main thing is we want you guys to understand the flow of things. So the subscriber puts money into the financial institution, which is the promoter. Then they make payments to the beneficiary. And then when that student is enrolled in the qualifying program, the payments they get are a combination of a refund of the original contributions, which are non-taxable, and income that's been earned within the plan, which is taxable. And that shows up in box 42 of the T4A and then is declared on line 13000. Now, can things go wrong? Yes, if the beneficiary does not enroll in post-secondary education, then the money in the plan has to be dealt with. So a tax-free refund of the contributions along with the taxable earnings are paid to the subscriber, not the beneficiary. So the refund of contributions, again, do not have any, that's just a refund of post-tax income. There's no effects there. But the accumulated income payment is reported in box 40 of a T4A slip, and it is included in the subscriber's income on line 13000. Notice it's not treated as investment income. And in addition, unless you can transfer it into an RRSP, there's a special 20% tax on AIPs in order to discourage taxpayers using this as a means to get around attribution rules or otherwise abuse the system. Any grants or bonds from the government are returned to the government rather than to the subscriber because the student did not carry out the terms of the bond. So, and again, here's a look at that graphically, just to help remember. So if a student is not enrolled in a qualifying program, right, then we get the results in blue. The contributions and the income earned are returned. Contributions are not taxable. The income earned within the plan is taxable. And then there's a special 20% tax if there isn't sufficient RRSP room. All right. So that's the types of income which apply to students. One implication of all that is that if you have a student then who is infirm or disabled, then it can be a legitimate discussion whether it makes more sense to be setting up an RDSP or an RESP. So these are concerns to be looked at, right? In general, though, if you are reasonably sure that a student is going to be going to post-secondary school, the RESP has definite advantages. Now, one thing to be aware of, if a student goes to school and then drops out of the program, this can have all kinds of implications. I'll try to touch on this when we talk about tuition fees a little later on, but in order to qualify as a student at tax time, it is necessary to have a tuition tax receipt from the post-secondary education institution, which shows the student as having gone to the institution and having attended classes full-time or part-time. In cases where a student drops out of the program, or doesn't pay their tuition, they may not receive that tuition form, and thus at tax time they will not be able to they will not qualify as a student, and then this can have all kinds of effects. So scholarships will become taxable, RESPs, may not be cashed out, and so on and so forth. So that's just something to keep in the back of your mind as we go forward. All right. Credits. Student loan interest has kind of a long policy history in Canada. It was first brought in the 1980s, and the general policy outlook at that time is that if you reduced student assistance but increased the ability of students to take out loans to finance their education, then this would be a great deal for everyone, as it would allow universities to raise tuition, and students could take out loans and finance their education. And then when they went on to get well-paying jobs, they would be easily able to repay the loans, and everyone would benefit. As we've seen in the decades since, the reality of it a bit more complicated than that. And there have been a lot of changes to student loan policy back and forth over the years, over the last 40 years, which a lot of which I've experienced. I don't need to, and a lot of people have experienced, so we don't need to go into the ins and outs of all the details. But a few things have stayed constant over the years. Student loans that qualify for the student loan credit on the tax return have to have been made, have to have been obtained from a government source. That is, they have to have been made by the federal government or one of the provincial governments. So they need to, therefore, have been made under the legislation that applied at the time, the Canada Student Loans Act, or the Canada Student Financial Assistance Act, or the Apprentice Loans Act, or a similar provincial law. And in addition, the loan must be repaid under the original agreement. So this means if you restructure the loan, if there is a restructuring, a consumer proposal, a bankruptcy, the loan is no longer a student loan and does not qualify for this treatment. Similarly, non-governmental loans, such as a student line of credit, does not qualify for this treatment. And historically speaking, student loans can hang around a long time. And as I say, the regulations around them have changed over the years, but generally speaking, an official receipt identifying the student loan and the student loan interest as such is required. This may be from the federal or provincial government. For some historical loans, which were issued under an earlier regime where they were provided by the government but through various financial institutions, these may be from the financial institution, participating financial institution, CIBC, RBC, what have you. Over the decades, the financial institutions got out of the loan business, so the student loan business anyway, and got into the student line of credit business. And so that type of loan is older and less commonly seen, but student loans can be quite large and can hang around a long time. They can be comparable to a small mortgage easily. So the documentation accompanying it, therefore, can vary depending on the precise scenario. Federal and provincial loans can also be on different receipts. The British Columbia Student Loan Centre, for example, issues separate receipts, or at least historically has, from the Canada Student Loans Centre. Some provinces integrated it with the federal government over the years as well. So depending on the individual situation, the individual loans involved, you may have the receipts might look different, the documentation might be different, but they all receive the same treatment. As long as it's interest paid on regular repayments of a student loan from a government source, it can be claimed on the tax return on line 31900 in Part B of Step 5. As well, the student loan interest can hang around and be carried forward. So it can be claimed in the year the interest was paid or in any of the 5 subsequent years, which is longer than, for example, charitable donations or medical expenses, than medical expenses, say. So student loan interest, you do have some time to claim it. But only student loan interest that's actually repaid can be claimed. So if it's paid or forgiven via a student interest relief program or similar program, it can't be claimed. Generally, only the claimable amount will be shown on an official statement for the year, or if it does show both, it will clearly identify the claimable amount. And lastly, only the student can claim the credit. So even if someone else makes the payment, even if a parent makes the payment, only the student can claim the credit. All right. Okay. All right. We could take a break now. This is the first of 2 break slides. What time is it, Doreen? It's 7:18. I see. Okay, students, do you want to press ahead a little bit? Do you want to go till 7:30, or would you like to take a shorter break now? I think if we go till 7:30, we'll take the full 15 minutes. But how do you guys feel? 7:30, Diane? Yeka? Okay. 7:30 it is. All right, I'm going to count on you guys to let me know when it's 7:30. Okay? All right. Marine, I'm asking them to help you out here. Okay, so just let me know when it's 7:30, guys. Otherwise, I will press onwards. All right, so then, since you haven't had a break, I think you should be able to get this question fairly easily. All right, where's our polls? That's all right. Oh, there's the polls. All right, so let's see how well you remember the rule then. So, how long do we have to claim student loan interest? Is it the year the interest was paid? Is it any of the next 3 years, any of the next 5 years, or any of the next 10 years? Right? Most of you are getting the correct answer. That's good to see. Some people aren't answering, but of course I assume that some people may be up and getting a glass of water at any given minute, or else they've fainted from too much tax knowledge. All right, WebEx is just going to pull that together for a few seconds. But the correct answer is C, the year the interest was paid and or any of the next 5 years. There is a complicating factor, which we will get to, but that essentially is the time limit for claiming student loan interest. All right, I'll just send those results out to you guys. Now, what can complicate claiming student loan interest is the tuition tax credit. This is claimed on a Schedule 11, the top of which we see here. So, as you can see, it's called the Federal Tuition, Education, and Textbook Amounts in Canada Training Credit. So we're going to be looking at the Schedule 11 in more detail in a little bit. But over the next several slides, we're going to be talking about the various requirements for claiming amounts on this form. Now, one thing to be aware of is that in the past, uh, people could claim both the tuition fees paid to a qualifying institution, as well as receive a monthly credit, essentially an allowance for general expenses. This was called an education amount, and a smaller monthly allowance for textbook expenses called a textbook amount. These credits, like tuition credits, never expire, and they could be carried forward into the future. Currently, there is no federal education or textbook amount, only a tuition credit, but the Schedule 11 still lists tuition, education, and textbook amounts because these historical education and textbook amounts can still be carried forward and into the future. I can show you an older form to illustrate that after the break. All right. But first we need to talk about some general concepts related to tuition. So, and Mohammed has a question about student loan interest for the last 5 years. We will talk about that in chapter 15. You don't need to refile the tax returns. You do what's called an adjustment. Essentially, you would just send in the student loan receipts for those 5 years for each year and say, please add this to the tax return. But we will talk about that in chapter 15, not to worry. All right. For now, we're still just gonna talk about generally about tuition, because this can have an effect on claiming student loan interest, as you will see. So, in order for tuition fees, therefore, to be claimed on the form, there needs to be a qualifying institution. So, post-secondary courses provided by, generally speaking, a college, university, or similar educational institution will qualify. Other types of courses taken other types of places will only qualify if the student is at least 16 and the course is specifically taken in order to develop or improve occupational skills, as opposed to a course taken for recreation, personal enjoyment, or personal development. See, before you ask, this course is taught by H&R Block. H&R Block is not a university, but this course is specifically intended to improve occupational skills, so your fees paid for this course qualify as tuition fees. We will be sending you a tuition receipt for those fees. Not to worry, assuming you're all at least 16. As well, in order to qualify as tuition fees, the fees have to be over $100, and they have to be incurred, not necessarily paid, in the taxation year. Sometimes similar fees can qualify. So fees paid to an educational institution or a professional association or a provincial ministry or something similar in order to take an exam that is required to obtain professional status will qualify. So exams to become a lawyer or something similar to that would qualify then. And examination fees for those exams will therefore also qualify, but not administrative charges such as application fees for a program. Okay, so hang on, Valerie. So this course qualifies because you've all paid more than $100, right? So tuition needs to be a minimum of $100, as you will see. So the tuition fees that show up in the T2202, there's a long list of what is eligible and what isn't eligible. What's on the T2202 as a tuition fee may not necessarily be only tuition, but may be other various sorts of mandatory fees paid by a student. Only the fees that are eligible are included on a T2202 slip or a similar official tuition receipt, and that is to say the institution is responsible for determining the eligible amount. If we feel the institution has made a mistake, we can request the institution to make a correction, but this is not. But in general, the T2202 is filed by the institution with the CRA, so the institution would need to make a correction to the T2202 if, in the event we felt there was some kind of mistake and some sort of mandatory fee should have been included and wasn't. Now, licensing examination fees, as I say, are also eligible if they're required to obtain professional status or to practice a profession or trade in Canada. And lastly, fees are claimed in the year incurred as opposed to when they were paid. So the classic example here, someone shows up to university in September and they pay for their entire year at once. So they pay for the fall term and the January term in September. Only the fall term is claimed on that taxation year. The January term will be claimed on the following taxation year, right? So this is similar to an accounting for business, basically, which says that fees and income are claimed in the taxation year they relate to, not necessarily the year in which they're actually paid. So this can trip people up to say, oh, I paid all this in September, or, that was the year before, I shouldn't have any tuition this year. And you say, well, actually, your January courses fall on the next taxation year. Notice that the reverse doesn't generally apply. You don't pay in January for the previous semester's tuition because universities have a habit of kicking you out of the university if you don't pay your tuition relatively promptly. All right. So for examination fees, again, just to stress, they will not necessarily be on a T2202, but they do need to be a minimum $100. And normally there's an accompanying letter which specifies that they qualify as tuition fees under the relevant section of the Income Tax Act. All right. So that then is tuition fees. And tuition fees need to be issued, at 7:30. Okay. See, great. Okay, well then let's just pause it there at 7:30. After the break, we'll go on to talk about qualifying institutions in Canada. All right, good stuff. So what time is it now, Dory?
7:29.
7:29. Oh, okay. Okay. Oh, I see you sent 7:30 earlier. I think 7:29 is close enough, don't you guys? All right, so let's break until 7:45. And after the break, we'll talk about qualifying institutions. All right, but do take a break, drink some water, stretch your legs, walk about a bit, and then we will resume afterwards. Oh, and pause. Don't forget to pause the recording. There we go. Okay, folks, welcome back. Begin in a moment or so, but let me answer those questions. All right, so to answer Muhammad's question first, partially it depends where the fees are going to be coming from. So tuition fees can be, as we've seen, are partially dependent on the institution, and they're also partially dependent on how much that is paid. So for an examination fee, it would need to be a minimum of $100 in order to be claimable in the first place. Now, to upgrade your professional status as a commercial driver, it is not necessarily going to fall under this provision. This provision is intended more for things like doctors' exams and lawyers' exams, where the professional status is recognized by statute. So simply increasing the degree of your driver's license, or let me put it this way, there's no threshold distinguishing a Class 4 driver from a Class 2 driver, I would say. So I would be hesitant to say that examination fees simply to upgrade your license would qualify under the tuition fee provision. They could well qualify as an employment expense or even a business expense, depending on the situation. But the examination fees here are really intended more for things like expensive fees for becoming a lawyer, becoming a doctor, and so on. There isn't really a hard line like that for a professional driver status. That said, if it's part of a course that you're taking through a recognized institution, and the cost is $100 or more, then that would be fine. If it is part of training, right, it would depend who is delivering the training and how much it costs, right? So often, if a training is being delivered through a recognized educational entity, then it would be claimable. But the $100 minimum would apply. Okay. Right. The exam for becoming a Class 1 driver, normally that fee would be included with the tuition paid for the training course, I would think. Not that I have a Class 1 license, you understand. All right, and Diane had a question about the guide that's referred to. So that is a publication put out by the CRA, a guide to the tax return, and you're wondering if about the page numbers not aligning. The CRA can edit and update the guide at various times. So the file might not be the most up version that you would get online, and so it might be out of sync with the forms provided. That's all I can say. But the guide is organized by line number, so you would look up within the guide, you would look up line 22000 of in the guide. So the page number might not align, but they would still be ordered by line number. So we can have a look at that after class and dig around in that and see what's going on there. It should be the same guide, but the CRA can update that guide at any time. So that's all I can think of, that the guide we have might not be the most up-to-date version. I have noticed that sometimes the forms and guides will look slightly different depending on whether they are downloaded from the web and printed out. Keep in mind that the original guide is a physical guide printed on paper. It's a physical booklet. So the page numbers in that physical booklet might not necessarily correspond to the page numbers of a PDF. That's another possibility, I would think. I wouldn't worry too much about it. But yes, we are using the official forms and official guides. Um, not to worry. Essentially, page numbers are just a function of formatting, and that can vary somewhat. All right. So for tuition fees, they can be claimed. So we've talked about what constitutes tuition fees, but they also have to come from a recognized institution. Now, some of these are obvious. So a university, college, or similar educational institution in Canada, University of British Columbia, the College of New Caledonia, Langara College, BCIT. That's all very clear. That's easy to understand. You can also claim them for courses that develop or improve the taxpayer's occupational skills, right? So the first point is for courses leading to a degree. So anything you take at a university or college that is leading to a degree or could lead to a degree or diploma can be claimed. However, any courses that are not leading to a degree, not part of a degree program, must be taken to improve occupational skills. This can, however, be fairly broad. So the CRA recently held that English or French language training, for example, was intrinsically related to occupational skills, for example. So for unusual courses, then, the question becomes is whether the person taking the course intends for it to be leading to an occupation or not. So someone studying basketry or floral arranging who is planning to become a florist, for example, and was taking those at a recognized institution, so through UBC or something similar, they could reasonably claim that those were occupational skills, for instance. The courses can also be claimed if they're taken at an institution in Canada that is certified by Employment and Social Development Canada, or at a post-secondary educational institution in Canada, but not at a post-secondary school level. So if you're taking a course through UBC that is not leading to a degree, that's what that's talking about there. So that could qualify there. For improving occupational skills, there are also corresponding provincial bodies which regulate other organizations. So, for example, if a driver's school is obviously not a university or college, but it is recognized by Employment and Social Development Canada or a corresponding provincial body, then that would be claimable. However, in all cases, the student claiming post-secondary tuition must be at least 16 years old on December 31st of the taxation year. However, of course, a 16-year-old, someone under 16 attending a post-secondary institution is going to be fairly rare. Right. Now, tuition from a recognized educational institution is issued on a T2202 slip. The modern slip replaced the older T2202A in 2019. So we've had this version of the slip for about 6 years or so. They made some substantial changes in 2019. Prior to that date, educational institutions would prepare tuition forms. The T2208A was the standard one, and the T2202 was for students who had a disability. But they were not filed with the CRA. So the CRA has no record of tuition receipts earlier than 2019. From 2019 forward, all T2202s are filed with the CRA. So these will be on file with the CRA, and notice that they will have the student's social insurance number on them, again, as of 2019. So some other information we're going to see here. Up here, the name and address of the educational institution, the name of the program or course, and the student's name and address down here. Up here, we'll see the type of school, the student number. 12 and 15 apply only to flying schools or clubs for someone getting some sort of pilot's license. And here is the heart of the form. So the semester of the school, 1, 2, 3, and 4, typically January to April, and then May through June, and July and August for the 2 summer semesters, and then September for December in the 4th session. But the specific month and year is listed here. So from, for example, for 2025, so it'd be 2501 to 2504 for the January to April semester for 2025. Then, corresponding to that, we have the number of months someone was a part-time student and the number of months someone was a full-time student, and then the eligible tuition fees from that period. And box 26 down here is the total tuition fees for the year. Box 25 down here is the total full-time months, and box 24 is the total part-time months. Now, when you have a student who has gone to more than one university, which is entirely possible, you need to be careful about the total of months that you enter for them in your tax software for the year. So just because one T2202 slip says they were a student for full-time student for 6 months, and they have a second slip saying they were also a full-time student for 6 months, you need to be careful that the months don't overlap and you're not claiming the same months twice. The maximum number of months you can claim in a year is 12, right? And so this means they need to have gone to school in 12 separate months, and you're not just claiming the same 6 months twice, for example. Other things to note, currently, most institutions allow students to download their T2202s online. If there is any difficulty getting a form, particularly for 2019 and earlier years, students will have to contact the institution directly to get another form issued. Now, there is a back page to the T2202. This is used when you want to transfer some tuition to a designated individual. So this could be either your spouse or common law partner or to a parent or grandparent, but this has to be filled out on page 2 of the slip. The highlighted sections are the ones that need to be filled out. So I designate the individual's name, my spouse or parent or grandparent, and they will claim this amount of federal tuition amount and this amount of provincial tuition amount. So keep in mind, the federal amount and the provincial or territorial amount do not have to be the same. It is entirely possible to transfer one and not the other. It is even, I believe, possible to transfer the federal amount to one person and the provincial to a different person, although in practice that's just not something you would see. You need to be aware, though, if someone is a resident of a different province, special rules may apply. And some provinces listed down here, you're not able to make this transfer at all. Alberta, Ontario, and Saskatchewan, in particular, do not allow tuition credits. We're going to get into that right this second. But you do need to be aware. In British Columbia, provincial tuition credits are still claimable. Now, if all of these are left blank, it just means no transfer is taken place. And so it is not required to transfer to a supporting individual, and indeed it is entirely at the student's discretion, although parents and grandparents sometimes have very strong feelings about this. But the transfer cannot be claimed by the receiving individual unless this form is signed by the student, because it is entirely the student's option as to whether to transfer or not. We'll talk in more detail about transfers a little later on. I just want to give you that kind of a briefing. So, again, I've mentioned it previously, tuition fees have to be over $100, and that is they must exceed $100 per educational institution. So if they charge you $100 and no cents, you cannot claim them. It needs to be $100.01 or more. Now, if multiple courses at a single institution add up to more than $100, that's okay. You can claim that. However, separate fees of $100 or less that are paid to different institutions cannot be claimed even if the total exceeds $100. Now, these days, with the cost of everything going up, it's fairly easy to hit the $100 limit, but do be aware of this. Certain minor courses or courses where, day-long courses, relatively short courses may not hit this threshold. Another rule is that tuition cannot be claimed if it's been paid by a third-party organization. So this means tuition fees don't qualify if they are paid by one of these following groups. So if they're paid by federal or provincial job training programs, they weren't paid by the student or supporting individual, can't be claimed. If it's a federal program to assist athletes, they can't be claimed. If they're paid by the individual's employer or an organization such as a union, and no related amount is included in income, that is, it is treated as a non-taxable benefit, it cannot be claimed. Because again, it is not actually being paid by the individual or supporting individual, it's being paid by a third-party organization. Similarly, if it's the employer of the individual's parent and no related amount is included in their income, it cannot be claimed. The CRA often requires taxpayers to submit a signed statement that the fees were not paid by a third party, and we, for example, provide a form that taxpayers can use for this purpose. Again, the key question is, were these fees included as income on a T4 slip, fundamentally? And just make sure we don't have any questions. Everything clear? That's good. All right. Now, I mentioned Canadian institutions, but tuition can also be claimed if someone's going to an institution outside Canada in some circumstances. Just as with charitable donations, there is some allowance for international institutions. So tuition fees paid to institutions outside Canada can be claimed if the institution is a university or equivalent to a university, and the student is in full-time attendance in a course leading to a degree, and the course duration is at least 3 consecutive weeks. So in this case, the $100 minimum fee rule does not apply if these requirements are met. However, the third-party rule still applies. So if the tuition fees were paid by a third party, they will not qualify for the claim of the tuition credit. Slightly different rules apply also to people who are living in Canada and attending a university across the border. We will get to that. Now, when I say university or equivalent to a university, what we basically mean is some institutions don't have the word university in their name. So, for example, some institutes in the United States that would be considered universities for this rule are places like the California Institution of Technology, the Colorado School of Mines, and Dartmouth College. So in practical terms, most post-secondary institutions are going to qualify whether they have the word university in their name or not. However, regardless, the requirement still applies that full-time attendance is necessary and the minimum duration is 3 weeks. Now, tuition fees paid to an institution outside of Canada are entered separately on Schedule 11, and you can see they're here on line 7 for CRA tracking purposes. And this makes sense if we remember that these tuition fees are not going to show up on a T2202. So the CRA they will not see this number and say, aha, this must correspond to a T2202, there's a missing T2202. The CRA can go, oh, okay, these fees will be showing up separately. As well, these fees are not eligible for the Canada Training Credit, which is claimed up here. We will talk about that a little later on. Now, in order to claim tuition fees, you do need proper documentation. So for schools in Canada, the most common is the T2202 form. So this applies to a Canadian educational institution or a flying school or club in Canada, but it can show up in one of these other forms. So the TL11A is for universities outside Canada. So the university outside Canada will fill that out. A TL11C is C is for commuters. So if someone lives in Canada but is commuting to a U.S. university just across the border, then the educational institution will fill out a TL11C. And TL11D is for deemed residents. So if someone is attending a university outside Canada and the student is a deemed resident of Canada, then the institution will fill out that form. Now you might wonder, is there a TL11B? Well, there used to be, but the TL11B was for flying clubs. And in 2019, when the T2202 was redesigned, the TL11B was eliminated, and now flying clubs fees show up on the T2202 itself. Okay. All right. Good stuff. So let's check your memory then and see how well you're remembering some things. So again, let's put our chat window up here. And Muhammad is asking, what is the maximum claim amount for going to school outside Canada? There is no maximum. The courses need to, the test would be whether they are a full-time equivalent or part-time equivalent, and that judgment is made by the school. So they are full-time if they require the student to be in an equivalent of full-time attendance online. So not all online courses would necessarily qualify. They would have to meet the criteria for qualifying, similar criteria to what would apply in Canada. But for example, if an online course can qualify as a full-time course, if the student is required to attend a similar amount of hours per week in virtual attendance, for example. All right. And again, there's no maximum amount for tuition which can be charged, although over a certain amount, the CRA is much more likely to want to see the tuition receipts. So, but first, let's see how well you remember. So first, true or false, all scholarship income is always exempt from tax. Do you guys remember? Good. The answer here is false, because it depends on the status of the student, right? It is always exempt from tax only for full-time students, right? In other situations, it may be it'll be partially exempt to one degree or another. Now, true or false? If you qualify, it is possible to claim tuition paid to a post-secondary institution outside of Canada. The answer here is true, right? You can claim tuition paid to a post-secondary institution outside of Canada if you meet the various conditions for it. And true or false, if your only tuition is from a local college and the T2202 shows $100, you can claim this on your tax return. True or false? Good. The answer here is false, right? It needs to be slightly over 100. It can be $100.10, and you will be fine. Also note, if you have more than one course from the same college and the total is over 100, that is also fine. But you cannot combine different schools to get over the $100. Right. When we are claiming amounts on the Schedule 11, then here's what it looks like. So we enter all eligible current year tuition amounts from one or more schools that have been paid to Canadian educational institutions on line 32000. Again, eligible tuition fees paid to an institution outside of Canada are entered separately on line 32001. These amounts are taken directly from the T2202 or the TL11A, C, or D. Enrollment information is also to be entered. So box 32005 indicates if a student is eligible for the disability tax credit or has a physical or mental impairment. This information did not used to be on the Schedule 11. It changed in the recent redesign. Box 32010 indicates the number of months in part-time enrollment, and 32020 indicates the number of months in full-time enrollment. Now, let's pull up a Schedule 1 just so you can, just briefly, let's pull up a Schedule 1 just so you can have a look at that and have an idea what that's looking like. And so Schedule 11. There we go. So as you can see, 32000 is the top line of the form, and then 32001 is down here, and the enrollment information is on the back. So it's a tick in box 32005 for if a student is disabled or infirm, and then the enrollment months are added here and here. Right. Again, prior to 2019, the disability information was not entered here, and students used two different versions of the T2202. A historical Schedule 11 prior to 2020 would look a little bit different. If time allows at the end of class, we can go and have a look at a historical example, but I do encourage you to, if we run out of time, I do encourage you to go have a look back at some of the historical examples on the CRA website, because older examples, 2017 and earlier, for example, you would see the earlier education and textbook amounts as well, which I will show you if we have time, but just if we run out of time, do have a look. All right, so when you're claiming the tuition amounts, then currently, any amount which is claimed or transferred for the year is calculated on the Schedule 11. Now, there's a very important rule around tuition amounts to be aware of, and that is they must be applied to reduce the student's taxes payable to zero if possible. Any credits used in the year are claimed on line 32300 in Part B of Step 5, and the amount of any federal tuition transfer afterwards is entered on line 32700 of Schedule 11. Any excess credits for the year can be carried forward or transferred, but the maximum transfer is only 5,000. Now, some things to keep in mind about tuition credits. They do not expire. Somewhat uniquely in tax, they are a credit which does not expire. They are similar to RSP contributions. You can claim them indefinitely in the future so long as you have contribution room. Tuition tax credits will hang around potentially forever until they can be used. However, they must be used to reduce the student's taxes payable to zero if possible in a given year. And there is a priority to it. So let's have a look at that Schedule 11 here. So when we look at it here, there is a calculation here, which is similar to what we saw with the Schedule 2. So we have to enter the student's net income and then enter the tax credits up to line 107. So line 107 is this subtotal here. It is all your tuition credits up to the disability amount. Any tax credits after this point cannot be considered. So interest on student loans cannot be considered. You must use your tuition first before you can use any student loan credit, before you can use any tuition amounts transferred from a child, grandchild, your spouse, your common law partner, before any medical expenses, before any donations and gifts. Right? Anything after line 107, right, cannot be considered here. So on the Schedule 11, then, we figure out the student's income for the year, and if necessary, we take the amount from line 81, the tax owing, and divide that by 15%. So if someone is beyond the first tax bracket, the tuition credit will get eaten up faster, is what that means. And basically, we claim enough of the tuition to reduce the tax to zero. And that is the amount which has to be claimed. Then, on the next page, we take this amount here, the amount which has to be claimed, and that amount comes down here. So we take the amount from line 10, which is the total tuition for the year that was actually paid, plus any unused credits from previous years. So we take the tuition plus any unused amounts, we deduct the amount which had to be used in the year, and then we have the unused amount. Now, when you're transferring, notice we do not consider the tuition for the year plus the unused amount. We only consider the new tuition for the year, and it's only to a maximum of $5,000. So we take this maximum up to a maximum of $5,000, and then we deduct what had to be used, and this leaves the unused tuition amount available to transfer. So this means any tuition over $5,000 for the current year cannot be transferred and must be carried forward if it's not used. All right, let's look at an example from the textbook to see how this can work out in practice. All right, so illustration 13.5. There we are. So Mel McAdam is 21, and Mel's T2202 is here. So it has $3,700 in tuition fees for the year and 8 months of full-time study. And Mel's only income for 2024 is from employment, and Mel's box 14 is $23,500. And we've got Mel's non-refundable tax credits up to line 107 is the basic personal amount of $15,705, CPP-based contributions of $990, EI premiums of $390.10, and the Canada employment amount of $1433. So the total of these non-refundable tax credits up to line 107 is $18,518.10. So Mel's total income $23,500, and the only deductions are the enhanced CPP deduction. So Mel's net income and taxable income are $23,300. And again, the enhanced contribution deduction, remember that's the income from the T4, $23,500, minus the exemption of $3,500, so that's $20,000. 1% of $20,000 is going to be a $200 deduction. Right, so Mel has a federal tuition carry forward amount of $1,500 from last year, from the notice of assessment for 2023. So this is what the Schedule 11 will look like. Now we're going to talk about Canada Training Credit later in the chapter, so don't worry about that part. There's an age requirement for the Canada Training Credit, so Mel is under 26 and doesn't qualify. All right, so we put in the new tuition for the year, the $3,700. We put in up here. And we put in the carry forward from the notice of assessment of $1,500. So the total available tuition, education, and textbook amounts is $5,200. Then we figure out how much this needs to be used in the year. So we take the net income, the taxable income from which is $23,300, and then we deduct the total of the non-refundable tax credits up to line 107, $18,518.10. So this leaves $4781.90. So we apply first the unused tuition from previous years. That's $1,500. That leaves $3281.90. This is the amount of 2024 tuition which has to be used. So the total tuition, education, and textbook amounts used this year is $4781.90. This reduces Mel's tax to zero. We note here that Mel was enrolled full-time for 8 months. This is important. If Mel had any scholarships, they would be considered exempt from being reported as income because Mel is a full-time student for at least 1 month. So to transfer the carry forward amount, we look at the total of tuition and unused tuition from previous years is $5,200. We deduct the $4781, which was used in the year. This leaves an unused amount of $418.10. Then for the new tuition in the year only, which is $3,700, this leaves minus the $3281.90. This leaves $418.10 as available to transfer. If Mel wanted to transfer, the $418.10 would be entered on line 24, and the line 25 would be 0. Mel does not, and so the $418.10 is available to carry forward to a future year. Okay, so that's a relatively simple example. What happens if someone didn't have employment income or just had scholarship income? Well, the employment income here, we're just specifying that so that we can calculate what the non-refundable tax credits are, right? If they have, the key figure is taxable income. The source of the taxable income is irrelevant for this purpose. We simply use their taxable income from, yes, there it is, from line 26000 is entered here on line 11. Now, if someone only had scholarship income is exempt from tax if someone's a full-time student. So if Mel only had scholarship income, their not only would their line 26000 be zero, but that income would not be entered on the return at all. Now, with scholarship income, interestingly, as I alluded to before, if someone drops out of a program, scholarships retroactively become taxable because retroactively that student has lost their full-time student status. And sometimes this can happen well after the fact. So someone begins a program in September of a year, and then they don't pay their tuition or what have you. So occasionally, their full-time student status is revoked later on, and then the scholarships become taxable. This can also happen in cases where the CRA asks to see a tuition receipt for someone, and the student either doesn't supply the tuition receipt or doesn't supply a statement saying that they paid the tuition themselves and no third party was involved. So in that case, the CRA again will, after the tax return's been filed, the CRA will retroactively say, aha, this person claimed to be a student, but they couldn't provide us with the tuition receipt. Clearly, they were not a student at all. And then retroactively, the scholarship income will appear on the return and become taxable. All right. So Ginjari. So if there is no income, we cannot claim any fee amount. That's right, because it's a non-refundable tax credit. There's nothing to claim it against, and the fees will either carry forward, or you can transfer up to $5,000 to a supporting person who can claim it. If a student does not have income, the tuition will just carry forward indefinitely. And a very common situation then for students is that they will go through 4 or 5 years of university with tens of thousands of tuition credits available, and so their next few years of employment will wind up, they will have enough tuition credits to offset the income from that employment. All right, I see it's coming up on 8:30, so I want to keep moving rather than get sidetracked into a discussion about the history of tuition, however interesting that might be. And certainly understanding some of the history of tuition is very useful to understand, why certain things are the way they are with the tax return. But we do have a lot of ground to cover. I want to make sure we get through it. So now we were talking about transfers. So again, that maximum of 5,000 is important because that sometimes throws people off because it can mean if someone's tuition is higher than 5,000, then the amount which can be transferred is relatively limited. As well, a student can only transfer unused tuition amounts to a spouse, common law partner, or a parent or grandparent, or the spouse or common law partner's parent or grandparents. And as well, there's a priority here. So married or common law students can only transfer amounts to a parent or grandparent if their spouse or common law partner does not claim the spousal amount. So does not claim amounts on line 30300 or line 32600. So the spouse gets priority. Before a tuition amount can be transferred, we have to calculate the amount available for transfer on the Schedule 11, and then the transfer amount is entered on line 32700. It is not important to note that it is not possible to transfer any amounts that were previously carried forward. So you can only transfer amounts from the current year. Previous year amounts are locked in. So transferring, you can only transfer it in the year you receive it. Otherwise, it will carry forward and stay with the student. And again, the designated individual needs to have a signed copy of page 2 of the T2202 from the student designating the transfer. Now, the receiving parent or grandparent claims the tuition transfer on line 32400 in step 5, part B, while a spouse or common law partner claims this on Schedule 2, and then it's included with any other transfers on line 32600. All right. Oh, okay. Let's look at another poll question. I feel like that question is similar to something we've already asked you, but that's all right. Certainly never hurts. Let's make sure I've got the correct poll question open, though. I've got question 3 twice. We don't want that. Right, there we go. Okay, so true or false then? I don't want an emoji. All right, so scholarship income for students is always taxable. True or false? I do feel like we've asked you this before, but that's okay. That's okay. I will alter this for my next class. All right. But unsurprisingly, it does mean that all of you have gotten the answer correct, and 10 of you have not answered at all, leading me to believe that there are 10 people who may be asleep or are away from keyboard in any case. I certainly hope those of you who downloaded this at home got it right, at least the second time. Okay. All right. So we took a longer break earlier, so we won't take a short break now. Yes, I think for my next class I will change that poll question and ask them something about transfers. All right. That said, let's give you this scenario. So Marwin is a full-time student and has a T4A showing $4,000 in scholarship income, and Marwin's T2202 shows 8 months full-time with tuition paid of $3,500. So if Marwin's taxable income is $8,000, how much in tuition credits must they use in order to reduce their federal taxes payable to zero? And Mohammed's asking, is it required that the grandparents' address should be the same? No, parents or grandparents can be at a different address. In fact, even the spouse can be at a different address. There's no address requirement with claiming tuition credits. Notice that this can lead to complications when transferring tuition to other provinces. So hopefully we'll get a chance to talk about that in Chapter 14. The individual provinces involved can have a lot of effect on things. But in this case, oh, you didn't get the answer for the poll question? Sorry. I thought I had sent that to you. No, the answer is false. The answer is false. Scholarship income is not always taxable. Right? In fact, it's usually not taxable, and in fact, usually is not included as income on the return. Okay, sorry. All right, so in this case, for Marwin, who has taxable income of $8,000, how much do they need to use in tuition credits? Good. Yes, Diane is correct. Zero. Her income is below the basic personal amount. Right? It's below the tax credits, which would be listed on line 107. Now, what about if Marwin's taxable income is $21,000 and Marwin's non-refundable tax credits up to line 107 total $19,500? How much in tuition credits must be used to reduce their federal taxes payable to zero? that the answer is 1,500, right? 21,000 minus 19,500, right? So it's generally speaking not too hard to figure out and explain to a student how it all works. Basically, if they have income over their basic personal credits, the tuition must be used to reduce their tax to zero. Now, working from this basis, so Marwan, again, full-time student, has a T4A showing $4,000 in scholarship income, and the T22 shows 8 months of full-time study with tuition paid of $3,500. If Marwan's taxable income is $91,000 and his non-refundable tax credits total $24,500, how much tuition credit of the $3,500 must be used? Good. All of it has to be used. It is not discretionary, right? The Schedule 1 dictates that it all has to be applied. It cannot be saved, cannot be transferred. But how about a different scenario? So, Marwan, full-time student, T4A showing 4,000 in scholarship income, 8 months full-time with tuition paid of 3,500. Now, previously we said if Marwan had taxable income of 8,000, they would have had to use zero of the tuition credits. In this case, then, what can Marwan do with the 3,500 of unused tuition fees? There are three basic options in this case. So you can Marwan can transfer all of the fees to a spouse or parent, grandparent, or Marwan can transfer some of the fees and carry forward the rest. That is also possible. Or Marwan can say, no, I'm not going to transfer anything and carry forward the entire amount. Okay? Just remember, if Marwan carries it forward, anything that Marwan carries forward cannot be transferred in a future year. The transferring is a one-time only option when new tuition fees are paid. Also note, right, so you transfer, carry forward, or a combination of both. And also note, every year is independent. Just because you transfer it one year doesn't mean you have to transfer it the following year, and vice versa, right? Every year is independent. And remember, on the back of the T2202 that we saw, the student can specify the amount to transfer. And it can be a different amount federally or provincially. In a situation where a student in British Columbia was wanting to transfer tuition to a student to a supporting person in another province which did not allow a claim for tuition, it's perfectly fine to transfer a federal amount, which can be claimed, and not transfer anything for the provincial amount. You're not locked into doing the same thing federally and provincially. Okay, now notice we mentioned the Canada Training Credit. So this is a refundable tax credit. Now, I'm going to skim over a very large discussion of policy here just to give you the general reasoning behind this. From what I've been saying, right, you can probably tell that you can understand what I was saying. Historically, what we've had is a situations where students would arrive at the end of their 4-year degree with tens of thousands in tuition credit, and then for the next few years they would be able to get all of their tax back at tax time. Various policy designers around North America have noticed that this tends to mean that students, while they are in school, are not receiving as much financial support as they need, and instead are getting really big tax refunds when they leave school at a point when, generally speaking, they don't really need the financial help so much. So there has been a lot of creative thought around how to shift that so that students receive more support while they are in school. Some provinces have done this by eliminating tuition credits and presumably increasing direct support to students. Hopefully, anyway, if you eliminate the tuition credit and don't also increase direct support to students, then it's just a cash grab. But that's the idea anyway. You eliminate the tuition credit and increase direct support to students. But as well, the government has brought in this refundable tax credit for older students in order to encourage people to go back to school and improve their skills. So this was introduced in 2020 in the middle of COVID, with all that implies. So a lot of people may not have heard of it, and during COVID, a lot of people didn't have the requisite employment income. But the idea was that for every year, beginning in 2020, you would receive a kind of allowance that to allow you a certain amount that you could get back in tuition if you took job improving courses. So depending on your working income in the previous year, providing you had working income in the previous year, you would get an additional $250 for this allowance. The maximum lifetime amount is $5,000, which would be 40 years working, beginning in age 26 and going until 65. The amount you get back, so the idea is, for this training credit, every dollar you have in the Canada training credit, every dollar of tuition that you pay, you get back $1 of the training credit. So the credit is the lesser of your Canada training limit, or 50% of the eligible tuition fees for the current year. So this means if you had enough room in your Canada training limit, if you paid $1,000 in tuition, you would get back $500 in tax time instead of the 15% normal federal credit plus whatever the provincial credit would be. So you would get back $500 instead of $150. So this really incentivizes going back to school and improving your skills. This is calculated in the first section of Schedule 11. All right, now the working income needs to be a minimum amount, and it's indexed for inflation, at least $10,000 in 2020, and your individual net income also needs to be less than the fourth tax bracket. So you need to be of medium, or low income. And you need to have employment income. So, for example, for 2024, it requires a minimum of $11,511 in working income, and your net income also needs to be less than $165,430. But assuming you have the Canada training, you have enough limit, then you will be able to get back 50% of your tuition dollar for dollar. But note, as I pointed out before, institutions outside of Canada are not eligible for this training credit limit. So that's why Canadian tuition is entered at the top of the form, then the CTC is calculated, and then foreign tuition is entered. All right, what's our time looking like? Not too bad. Not too bad. All right, I'm going to show you an illustration for this, but I am aware we are got about 15 minutes to go, so I am going to show you this illustration, but make it quick. So 13-8 is an illustration. So Marlon turned 32 in 2024, and in every year since 2019, Marlin had sufficient income to qualify, and so they've accumulated $250 every year towards their Canada training limit. So their accumulated limit as of 2024 was $1,250. In 2024, Marlin incurred eligible tuition fees of $900. So therefore, Marlin can claim a Canada training credit of $450. So this is 50% of $900. The remaining Canada training limit that carries forward is reduced to $800, so that's $1,250 minus $450. But because Marlin worked a minimum amount in the year, Marlin also gets an additional $250 because they fell within the necessary income parameters in 2024. So this remaining limit is not lost, it simply carries forward. And the remaining the remaining tuition, $450, that's not claimed here, it's not lost, it's simply claimed as a standard tuition credit on line 32300 or carried forward depending on the situation. So for example here, so Marion, 28, is a resident of BC, and in 2024 paid $1,700 to take a course in hotel management. And this was certified by Employment and Social Development Canada to issue tuition fee receipts. And Marion has a Canada training limit of $750. So instead of just claiming the entire amount as tuition fees, she can claim a Canada training credit of $750 and tuition fees of $950. So the $1,700 is entered up here because it's from a Canadian educational institution. And again, notice foreign educational institutions happen after the CTC calculation. So we take the tuition credit, 50% of that tuition is $850. The limit from the latest notice of assessment is $750. So Marion can claim the $750 as a credit on line 45350, and the remaining $950 is available to carry on to the rest of Schedule 11, and then this can be claimed as a tuition credit or carried forward. So again, as you can see, the Canada training credit basically happens right at the top of Schedule 11. Pardon me. And then whatever remains goes on to the rest of the Schedule 11 to calculate whether it needs to be applied in the current year to reduce taxes or not. Now, there are specific rules around interprovincial transfers and carry forwards. When we talk about Chapter 14, I'll get into the rules for British Columbia rather than bogging us down right now near the end. Depending on the situation, the allowable amount may be based on the originating province or the province where the transfer will be claimed. Right? So you need to look at the specific situation. We will touch on that when we talk about Schedule 14. Again, interprovincial transfers are where the student and the person they want to transfer to live in different provinces. There's also provincial carry forwards, is when the student moves from what has carry forward amounts from previous year and then they move to a different province. Depending on which province they're moving from and which province they're moving to, this can be beneficial or not so beneficial. Now, moving expenses for students. This is actually pretty straightforward. Moving expense claims for full-time students are limited to the taxable amount of their scholarship and bursary income. And remember, for most students, their scholarship and bursary income is not taxable because it is not considered income. So this special provision for students to claim moving expenses, therefore, is now only generally applicable. In practice, it's generally applicable to research grants. So if you're moving to another province to do a research grant or a postdoctoral fellowship where it's not treated as scholarship income, but instead treated as taxable income on line 13000, then you can claim moving expenses. Students who have summer jobs and are moving to work for the summer have to meet the change of residence requirement. So a student who just goes to work in a fishing lodge up in Haida Gwaii for the summer hasn't really changed their residence. As well, students living in student residence on a campus, often this is not considered to be a true permanent residence either, and so this can also, the CRA often will not consider going and living on campus, temporary student housing, to be a change of residence either. So determining a student's correct province of residence is therefore important and often more complex than you might seem. Now, but as a general rule, a single student who's renting accommodation off campus while going to school is normally going to be considered to be a resident of that province. But if it's temporary accommodation, such as student residence or Airbnb or something, then we need to look at secondary ties. In ambiguous cases, be careful. The CRA has been known to challenge a student's residence claim. This is particularly common for international students or students studying out of province. Adult basic education assistance is another relatively simple one. This is income that's supported on a T4E if the benefits are identified as non-taxable tuition assistance, in box 21 on a T4E slip. They can be instead deducted on the tax return on line 25600. And if instead, so non-taxable tuition assistance, this is basically high school level type courses. If the benefits are instead identified as taxable tuition assistance, normally this is for post-secondary courses. And in that case, the program will qualify for the claim of tuition fees. So in that case, the person gets to claim the offsetting credit for the tuition fees. So you just need to check which box of the T4E is involved. All right, so one last poll question. Let's make sure I've got the correct one this time. There we go. So true or false, all adult taxpayers between 25 and 65 can claim the Canada Training Credit. All right, let's set our timer for 1 minute. And let me know what you think. Okay, so for this one, right, the answer is false, because although the age limit is correct, adult taxpayers between age 25 and 65, it is a requirement that they have a minimum amount of working income in order to build the Canada Training Credit limit, right? Someone who only has income from investments or non-employment income sources that doesn't reach this threshold will not be able to claim it. Okay. Karina, you're saying previous slide, sorry, 26 to 65? I think that's meant to be between ages 25 and 65, but in either case, it's the employment income requirement is the key thing that's missing there. It's it varies by it varies by year. It's indexed for inflation. So initially it was 10,000, and in 2024 it is, for example, it's 11,511. So it's for taxpayers aged 26 to 65. So this means between 25 and 66, I suppose. Let's change. I will change the wording. I will change the wording on that just to eliminate any ambiguity. But the key thing that's missing there is the employment income, and that's the thing to watch out for. If we were to ask you something on the exam. All right, so with our last few minutes here, so first I'm going to touch on chapter view problem 13-1, just to remind everyone, right? This is going to be 20% of your final mark. We assigned this last time, and the assignment is due prior to being reviewed next class, and we review it at the end of next class. There will be no extensions. If some sort of disaster happens, your computer catches fire, there's some sort of personal issue, you need to let me know. But if I do not hear from you, no extensions are normally granted. And again, the assignment due date is in the schedule, which has been sent to you all. So let's have a look at that problem now. 13-2 is an optional problem. I think because we're coming up on 9 o'clock, I'm going to spend our last few minutes just going over chapter view problem 13-1. 13-2, if you guys want, we can look at it next time. Or if you would prefer, if you do that, we can just briefly go over the answers next time, rather than sinking some time into it. If you want, you can just send me an email this week and let me know what your general preference is. But I do want to focus on 13-1. So 13-1. So this is for Parker Patel, Morgan Martin, and Ash Martin Patel. And Ash's date of birth is up here. So Morgan and Parker are common law partners and the parents of two children, Ash and Avery. And Avery is a bit younger, born in 2014. Ash graduated from secondary school in June, receiving a scholarship and a corresponding T4A. Ash took the summer off to do some traveling, and in September began full-time study at the University of York Province. Ash lives in a university residence during the academic year, but uses River Road as their official address, the address above, parents' address. And in addition to tuition of $3,000, Ash spent $350 on books and $25 for student association fees and has receipts. Ash's T2202 shows that they attended university full-time for 4 months and wants to transfer maximum tuition amounts to a parent. Parker works as a meteorologist. Morgan works part-time as a graphic artist, and we have their information slips below. There's also some medical expenses that you're going to have to evaluate. Parker has official receipts for these expenses, and there's a health insurance plan Parker paid through work, and those fees are down here in box 85. Morgan was in hospital for 6 weeks during the year. All expenses were covered by their health plan, but Morgan paid Violet Lalonde $2,500 to care for Avery after school on working days during the 6-week hospital stay. Parker and Morgan both have RSP accounts, and Parker contributed $4,000 into their own RSP account in December and $5,000 into a special RSP for Morgan in January 2025. Morgan has not contributed into RRSPs for the last 4 years. Parker's deduction limit is $55,000. Morgan's RRSP deduction limit is $2,500. All right. So quite a lot going on here. So you're going to get to practice a lot of the things that we've been handling in class. So there's some student material, there's some medical expenses, there's some RRSP things to look at as well. So a lot of moving parts here. So for Parker, we have the T4 for $75,750. For Morgan, we have a T4 for $12,580. And for Ash, we have a T4A with $5,500 in scholarship income. And then we have Ash's T2202 here. Okay, so now the assignment is going to have questions about all the taxpayer situations. You only need to prepare Ash's federal tax return and Schedule 11. Right? So doing that, you will then be able to answer the questions that you'll be able to have in ULearn. Again, you can use the fillable forms package or otherwise download the forms to complete Ash's federal tax return and Schedule 11. Complete the required forms and schedules using the forms package, save them in your computer, and then log in on ULearn to answer the questions in your transcript. So remember, when entering numbers, never use the dollar symbol. All entries have to be entered as numbers with the correct use of commas and must be entered to exactly 2 decimal places. All answers need to be correctly rounded to 2 decimal places to get the mark. So even if an answer is off by a penny, it is wrong. All right, and again, Morgan didn't have a box 22. Yep, that's correct. So this can arise when someone's employment income is less than the basic personal amount. So in that case, the employer is aware of that and didn't deduct any income tax. Or Morgan could have filed a TD1 with the employer and said, my income is going to be less than the basic personal amount, so you don't need to take off income tax. So this is entirely possible, although it's not necessarily common. Now that's a fair question, but the instructions in the textbook are that it only needs to be Ash's federal tax return and Schedule 11. I suspect the other questions you should be able to deduce based on the other information provided. Right? I will double check. I will double check that if there's anything else that you would need to know. I will let you know. But for example, I would not be surprised if there was some sort of question about medical expenses or some sort of question about RRSPs where you didn't need to do a return, but you might need to answer some questions about the situation, right? But I will double check and just double confirm just to put your minds at ease that you're not going to need anything specifically requiring a full-on return. Right? So you do the assignment on your own time. That's why we don't have class next Monday, right? So if the only time of the week you have free to work on things, you could do it next Monday during class time. Remember, there's no class next Monday. Our next class is going to be next Wednesday. No, it would take me a few minutes to check, so I'm not going to do that right now while we're recording. But I'm reasonably sure that you wouldn't need to do the full tax returns for everybody. Okay, but I will set your mind at ease about that. I'm reasonably sure, it would be a situation, you know, if we are asking questions that aren't to do with Ash, it would be, for example, something about the RSPs or something about another credit that the parents are claiming, where it would be very easy to figure out from the information you have here without doing the full return. Okay, so I'm just checking my notes here. So, what you might think about if we were to ask you about, uh, say, RSPs or medical expenses or childcare expenses, you might find it helpful to fill out the form which you might use on the return, but we're not requiring you to do that. But the forms can sometimes be helpful. Let me say that. I think that's fair. But the main thing is, whatever you're doing, whatever preparations you're making, you need to do that on your own computer beforehand. So download any forms you need to your computer. Use the taxpayer information from here to figure out everything that you're required to. Remember, answers need to be accurate to the penny. Then save all these forms and things to your computer as a new file name so you don't overwrite the blank fillable forms. And when you are entering the information for assignment 2 in your transcript, I want to stress, do not open that data entry tab in ULearn until you definitely have finished all the steps above. Your preparations are complete. You've done that return. You've done any required schedules. You've done anything else that you think you might be asked about relating to the other 2 people. And then, once the data entry screen is open, the timer starts, and you will have 3 hours. So you need 3 hours of uninterrupted time. The timer cannot be paused, and it cannot be restarted. So once everything is ready, log into your Learn account, go to My Transcript, open the Assignments and Tests curriculum, and then keep your returns and schedules open in a separate page, and then answer the questions in the assignment to answer data entry in ULearn. The assignment will have a blend of multiple choice and fill in the blank answers, and you've got 3 hours to enter your answers. So again, make sure you have 3 hours uninterrupted time. No one's going to come in and bother you. Don't answer your phone. Just lock your door. Make sure no one's going to disturb you while you put in the data entry. And at the end of the 3-hour time limit, the exam will close and save your responses. And again, in the event of a power failure or similar issue, you contact the technical support that is listed in your learner guide, and they can give you guidance. I am unable to restart it for you. And again, no dollar symbols, and answers need to be accurate to the penalty. And yes, spouses do separate tax returns. In Canada, they do. All right, so then for 12, so for 13-2, we'll talk about that next time if you guys have a chance to do it. Otherwise, in this session, we've talked about the different reporting rules for income relating to students. We've talked about RESPs in general and how income related to RESPs is treated on the tax return. And we talked about the rules for claiming student loan interest, as well as tuition credits, and how tuition credits have to be given priority over other things, including student loan interest. If they can be claimed, they must be claimed, but if they do not have to be claimed, then the unused tuition amounts on the Schedule 11 can either be transferred or carried forward, depending on the situation. If they are not transferred within the year, they must be carried forward. In future years, they cannot be transferred. They can only be used or carried forward. And we also briefly talked about adult basic education assistance and eligible moving expenses relating to students in the Canada Training Credit. All right, 13-2, we can certainly go through that next class. If you would like to, however, if you want to work on that before doing the assignment, because you think it might be helpful, have a look at that, and just feel free to reach out, and I'll be happy to, if you want some answers about 13-2 before our next class, I'll be happy to help you with that. All right, but yeah, right now we're just running up against the time. All right, and yes, otherwise assignment 2 is similar to assignment number 1, so you can navigate between questions, and the 3 hours should give you enough time if there's something where if you need to do some math or figure something out, you should have enough time to figure that out. You're just not going to have enough time to do ASH's entire return and everything from scratch, so you need to do your preparations beforehand. And Mohammed asks, is it if you get a low score on the assignment, then it should be 20% for final marks, or we passed the assignment, then you counted for final marks? So this assignment is worth 20% of your final grade. So whatever you score on the assignment, it will be a fraction of 20% of your final grade. So if you get 100% in this assignment, then you get 20% of your final grade. Your final grade, 60% of that is from the final theory exam, 20% of that is from assignment number 1, and 20% of that is going to be from assignment number 2. So for example, if you score perfect on assignment 1 and assignment 2, you will be going into the theory exam sitting at 40%, and then you will be starting at a minimum of 40%. So it really will give you a boost to trying to get to that 70% in order to pass the course. All right. On that note, though, we've been at it for a while. So for next time, then, just to stress, assignment number 2, 20% of your final mark, due before we review it next class. We're going to review it at the end of next class, which is next Wednesday. There is no class on Monday. For next Wednesday, look at Chapter 14 and 15 in the Inc. doc and the British Columbia Provincial Supplement. There are some topics which I've had to push down the road, which we're hopefully going to look at when we do Chapter 14. So I do want to look at the British Columbia Home Renovation Tax Credit. We'll look at the specific rules around tuition transfers and carry forwards in British Columbia for interprovincial transfers, and anything else we have time for. If there is something relating to British and the BC Renters Tax Credit, hopefully we'll have another look at that. If there's anything specifically for British Columbia, though, that you would like me to touch on, do reach out and let me know via email. Okay? And in fact, that also applies to those of you who've downloaded this online. If there's something specific related to British Columbia you would like me to touch on in our next session, you can email and say, hey, Brian, could you talk about this? That's perfectly fine. That's brian.clark@hrblock.ca. Okay. So for all of that, Thanks, everybody. So we will end our recording there. Thanks, those of you downloaded online. Good luck on assignment number 2. We will see you after next Wednesday. And for